Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, cut your taxes, and have a beautiful retirement. What could be better than that? I'm one of your co-hosts, Ben Barzideh. I have my partner and co-host, Matt Nadeau, here.
Hi, everyone.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located right here in Barrington and serving the greater Chicagoland area. And of course, our fiduciary obligation to put our clients' interests first is the tenet of our company philosophy. It guides every decision that we make. And as an independent firm, we truly have the freedom to focus solely on you and not some corporation.
As always, we want to just take a moment. We know we have some of our faithful clients out there who listen to us every week. Thank you so much for listening. And of course, also thank you for placing the trust in us, and just want you to know that we love every one of you. And we have a great show planned for today. So a couple topics. One, we're going to spin the first topic to get a little spooky. We're going to be talking about, Halloween. So what's this three-headed monster? Something that's lurking in the market that makes us pause and maybe worry a little bit, where it's not all beautiful and sunny skies. So we're going to talk about what those three things are, what we're watching for, what we're worried about. And then I guess we'll keep it in a theme. We're going to go Goldilocks this time. And now we're going to talk about what that is for the Goldilocks zone for Roth conversions. There's a time that's just right when to do them. And we're going to talk about it later. You don't want to miss that either.
Such a good show. But before we start, we encourage you to follow us online at BN Wealth social media pages on Facebook and Instagram. Also, check out our new moneyhourradio.com website, where you can access this and any of our previous shows on your favorite streaming platform like YouTube, Apple, or Spotify. And lastly, please subscribe to our weekly economic newsletter that's called the 5-Minute Market Brief. It's very informative, it's succinct, easy to read, and you can sign up for it on our website at bnwealth.com. And we get so many compliments, by the way, about that newsletter. All right, Matt, let's get into our first topic today. The three-headed monster currently lurking in the market. Man, that sounds scary.
Yeah, it's like one of those old, these horror films with the bad animation.
Yeah, the B movies.
Yeah. Well, listen, it's October and it's in honor of Halloween. And we want to just talk about something that may be downright scary. And it's not really being discussed much behind all of this market euphoria and excitement. But there are legitimate risks that we are seeing. And these are ones that maybe wake us up at night, make us worry, check under the bed, stuff like that. So let's be clear. First and foremost, we're not predicting that these bad market events are going to happen, maybe not anytime soon, but it's not a stretch to think that they may happen. And importantly, we are prepared just in case they do. And we want to let you know what they are so you're potentially prepared. So for us, it's great to hope for the best, but you need to have a plan for the worst. And that's our philosophy behind our advance and protect process. We have an investment strategy where we utilize it to help manage our clients' portfolios and take advantage of upside while also protecting on the downside.
So the three-headed monster, the first part of it, scary situation number one, is that we're in an AI bubble. And there are some potential big red flags. And we've previously talked about them here on our show the last few weeks. For instance, the growing number of circular financing arrangements between NVIDIA and an increasing number of its biggest customers. And NVIDIA is basically paying its customers to buy from them. And it's not unheard of. It's a concept that's actually reminiscent of similar moves by Lucent Technologies and other telecom names back in the 1990s. But it does add additional risks. And meanwhile, some AI companies seem to be little more than just middlemen in the AI capital expenditure explosion, like AI darling CoreWeave, for example. But there's many others as well. CoreWeave, by the way, is essentially buying computing power and renting it out to AI companies. And the company will have little to no value if this exponentially growing computer demand suddenly slows for whatever reason.
Yeah. And again, there are other industries that use these concepts, the automobile industry. So it doesn't mean it can't work, but we've got to be careful It's so strange. And then that's when also you think about this explosive valuations that are coming out for these private AI companies that really, as of yet, they don't have any clear path to profitability. And it does require a little bit of like reflection, especially given all this money and expenditures on AI. It's bottom line, all this money they're throwing at it, it better work. Now, there is so much enthusiasm right now in AI. It's like no one cares. And for now, there's a good chance that future expectations for AI will develop as hoped and the investments will be worth it. However, if it is indeed a bubble, then it is a big one. Given the large concentration of tech and AI companies that are in the market, especially like the S&P 500 and maybe many other indices, boy, if the bubble pops, shout, it's not good.
No doubt. So let's talk about scary situation number 2, which is credit stress hitting the economy. So current data is showing that consumers are under stress, especially some of the lower income families. Income growth has basically stalled, and prices for items keep rising. So, for example, just last week, CarMax, a company that caters to your average consumer, joined a growing chorus of companies that saw its loan delinquency rate spike. And fears of this weakness spreading and turning into a full-blown debt crisis is, I think, going to weigh on growth, and it will stretch the financial markets going forward. Now, to be clear, we're not talking about like a 2008 style event, but a smaller one maybe.
Well, that kind of leads into scary situation number 3 is, all right, all this debt, people are already having a hard time paying for it. Well, what if the job market gets worse? And in fact, the labor market is getting worse. It's not much of a debate. It's weakening. It really is just a matter of how bad does it get. So currently, markets are assuming a little more deterioration, but are generally resilient growth. So they're not worried about it. Unemployment rate rising maybe to 4.5 or 4.6% and staying there. Not really a big deal. But reality often paints a different outcome. It said risk happens slowly and then bam, all at once. Meaning, unless conditions improve, labor market weakness tends to continue and then something breaks and it gets worse. So today, Americans are actually spending more money and they're getting by even despite these higher prices because they still have jobs. If the labor market tanks, then consumer spending goes, and that's how you get a recession.
Now, here's the really scary scenario, the horror movie.
Oh, no.
What if all 3 happen at once?
Ugh.
Which, by the way, is probably not the most likely scenario, but it's not impossible either. What if the AI bubble deflates, the lower end consumer finally buckles, and that creates credit issues for the economy? Unemployment also continues to keep rising, causing a broad slowdown in spending. Then you add on to that the weight of the still high interest rates that we have right now, some of the tariff chaos and confusion, and the low consumer sentiment that we're seeing. And voila, now you have the ingredients for a full recession. And that would be truly a perfect storm of bad things happening, and is the horror movie environment that would result in what could be a really bad market crash, one that could take many years to recover from, maybe like the 2000 or the 2007 market crash. Those were certainly some big ones.
It's like everybody's trying to enjoy their weekend, Ben, and you're just like trying to scare them. All right, I'm going to give you the good news for now. It's not a today problem, but it might be a future one. And we're having a little fun with the Halloween theme. We are still very bullish on the market. And in fact, some of our more growth-oriented models are pedal to the metal, 100% in equities. Some of them have the Magnificent Seven stocks in them, where it's just really been taking off. Some of our portfolios have precious metals, which it's just like, what's happening there? They're taking off. So we are bullish, but it's important to keep an eye on it. And we monitor our investments every single day. And if the market gets riskier and conditions deteriorate, we actually will do something about it. Most advisors don't. We'll get more defensive by actually selling out of the market and going heavier into bonds or cash while we wait for things to improve. And we feel that if you're in retirement, it is paramount to have a defensive plan with your investments, a disciplined sell strategy to get out of the market and protect your money if the risk gets too high.
So, To explore becoming a client and learning more about this, you can contact us and schedule a complimentary consultation. Also, we're going to have a very nice high-end wine tasting event in a couple weeks coming up. We'd be happy to have you there, learn a little bit more about us, have some good wine. It's going to be on Thursday, October 23rd from 6 to 7:30. All right, don't go anywhere because when we come back, we're going to talk about the Goldilocks Zone for Roth conversions.
Welcome back, and thank you for tuning in. This is the Money Hour Radio, a show where we try and help you grow your money, pay less taxes, and have a beautiful retirement. And I'm one of the hosts, Matt Nadeau. I have my co-host with me, Ben Barzideh.
Hello, everyone.
And we're both founding partners and wealth managers at Barzideh and Nadeau Wealth Management. It's a comprehensive financial planning firm located right here in Barrington and serving the greater Chicagoland area. And before we went to break, we were running a little short on time, Ben, and you were about ready to talk about our high-end Bordeaux wine tasting workshop. Now, this isn't Bordeaux, it's Bardo, like our last names, Barzideh Nadeau. Get it? All right, listen, this is going to be a fun event, and we are inviting you, our radio listeners, to come out. If you're curious about potentially working with us, and also you want to have some fun, have some great wine, some appetizers, this is a great, fun, no pressure environment where you can come, hear a little bit about us, a 15 to 20 minute long presentation, and we'll tell you what makes us unique. We'll hear more about our firm. And then we're going to just dive into having some good wine and some hors d'oeuvres and our favorite bottles from the Prisoner Wine family. So it's Thursday, October 23rd. It's in our office in Barrington, and it's from 6 to 7:30 p.m. Now, just go to the website, moneyhourradio.com, or call our office at 847-780-2980. And please sign up today. Their seating is limited, so we're running out of time, but October 23rd, we'd love to see you then.
Now, this is along the lines of our motto, which is do great work for our clients, have fun. We have a ton of fun events, a wine tasting. We had a big client appreciation event a few weeks ago. We have a lot lined up. And then the third part of our motto is give back. And we believe that with prosperity comes purpose, and we value churches and other charitable organizations that are helping our local community and beyond. Therefore, we are proud to introduce Be and Giving, the philanthropic arm of our company. And we don't just talk about purpose, we actually want to invest in your purpose with you. And if you become one of our clients and you're a faithful tither or a regular giver to a charity, as long as it's an official 501c3, just let us know and we will match your donation up to 10% of the management fee that you pay us every single year.
Yeah, and this is more than just a program. I mean, this is a movement that we are pioneering that is unique to our firm. And it's one that celebrates a culture of giving and a more altruistic way of doing business. So by partnering with like-minded clients who share our vision for generosity, we aim to align our values with yours and helping your generosity go even further. So as our firm grows, so does our collective impact. So by the way, if you're out there and you're not a regular giver, that's okay too. We'd love to have an opportunity to work with you, but if you are a giver, this is a great opportunity. So if you want to explore how you can join our tribe and become a client, reach out online at bnwealth.com or call our office at 847-780-2980. All right, let's go ahead and jump in, Ben. Let's talk about this Goldilocks Zone.
Goldilocks Zone. So what we're talking about is the sweet spot for potential Roth conversions. And when people retire, it's very common for them to potentially drop maybe a tax bracket or two since you're no longer working and you don't have any more earned income. For example, a couple that may be in the 24% tax bracket while they're working, once they retire, they could easily find themselves in potentially in the 12% bracket, which is 2 brackets down. Now, once they reach age 73, these retirees have to start taking what's called required minimum distributions out of their IRAs and other type of tax advantage retirement accounts. Also, they may have delayed Social Security to age 70 to get a bigger paycheck. While when all of this extra taxable income kicks in after age 70, it's not uncommon for them to jump right back up into another tax bracket or two, like the 24%, for instance, or maybe even higher, and often stay there in that higher tax bracket for the rest of their lives.
Yeah, and This is a real critical time frame because you mentioned it could kick in and go higher after age 70 for the rest of their lives. If you think about with this one big beautiful bill that passed, these next few years, if you're in that 65 age range, you're going to get a bigger standard deduction only for a couple years. So this is going to be important. You may be in these low brackets for only a little while, and now you take advantage of it. So this solution to keep your taxes from creeping into higher brackets once you get to 70 or above is through these strategic partial Roth conversion strategies over a number of years. So let's just do a real simple example. Let's say a couple retires at the age of 65, meaning they may have like a 5-year window, which we call the Goldilocks zone. So from age 65 to age 70, they can take advantage of being in a lower tax bracket and to cut their taxes through the use of these tax bracket Roth conversions. So the idea is you want to pull money out of your pre-tax IRA while you're in these lower brackets, like the 12% bracket we're talking about, and then do a conversion over to a Roth IRA. You're going to lose right now, obviously, pay some taxes, 12 cents on the dollar, when you do this conversion. But obviously, the benefit is you could save big time on your taxes in the long run by doing this. So keep it simple. I'm going to just do a real quick illustration. Let's say we've got a couple, Bob and Alice. They're filing a joint tax return and they retire at age 65. And they no longer have any earned income because, hey, they're retired. And they drop all the way down to the 12% tax bracket. Let's also assume they can trigger an extra $50,000 a year in taxable income and still be in the 12% bracket. That's not that odd.
No, by the way, we often see this very same example with different clients and people in retirement. It's actually pretty easy for a couple to be in the 12% bracket and still have a comfortable level of income because that tax bracket now, the 12% bracket, goes all the way up to almost 97,000 of taxable income. And that means that's after all the deductions. So in addition, the next few years, like you mentioned, Matt, under the One Big Beautiful Bill Act, it creates an even bigger opportunity for Roth conversions since the standard deduction has been massively increased for seniors over 65. In fact, you can add another 6,000 a year per person or 12,000 a year per person if you're married, for a married couple, to the standard deduction, combining to almost $47,000 for couples right now over the age of 65.
I mean, that's just incredible. I mean, that so many retirees are going to find themselves in a much better tax situation, and it's going to again, help them with this strategy. So I'm glad you brought up the numbers, Ben. So like using those numbers, let's go ahead and go back to this Bob and Alice where they had that $50,000 left over of taxable income they could use up before they get out of the 12% bracket. So let's just say they take that $50,000 for that 5-year period. They've basically converted $250,000 of their pre-tax IRA to a Roth IRA over that time and minimizing this tax hit on them. And again, then later in retirement, not only will this strategy help them keep their taxable income lower because they're going to have less forced RMD from their IRA and they don't have any forced RMD from their Roth IRA. Beautiful, right? And then the other thing is if they need a little extra money from their IRA or their Roth IRA, any money they take out of their Roth IRA for the rest of their lives will be free. So no taxes. So who doesn't love tax-free income, right? So this is a great concept. It's powerful, but it has to be done right. As if you have too much income in any one year, you might run into some problems. It could potentially not only raise your income taxes, but also maybe impact Social Security taxes, your Medicare premiums. So you don't want to do this blindly.
No doubt. And when we talk about Social Security taxes potentially going up, it's called the Social Security tax torpedo. And if you're not careful with the income, it can very quickly cause a huge percentage of your Social Security to get taxed where otherwise it may not have. And then IRMA are those additional Medicare increases that you're talking about, Matt. We actually did a show about that a few weeks ago, but there are definitely some things you need to be aware of when you do this. So definitely work with a professional in this area. We'd be happy to help you, of course, by the way, in that area of financial planning and investments. So come see us if you have any questions on that. But before we wrap up for the week, we want to announce again that we're going to have in just a couple of weeks a very fun event. It's our high-end Bordeaux wine tasting event. And this is a fun event solely for new people that have been listening to us, maybe curious about potentially working with us. It's a very no pressure, fun environment where you can meet us, drink some good wine. We'll give a quick 15, 20-minute presentation on how we can help you and what makes our firm unique. We'll have some food and some of our favorite bottles from the Prisoner family of wines. And it's going to be on Thursday, October 23rd from 6 to 7:30 p.m. right here in our office in Barrington. It should be a ton of fun, basically like a cocktail reception hour. And so to register for it, please call our office at 847-780-2980.
Yeah, and you can go to our website, moneyhourradio.com as well. And again, we encourage you to follow us online. We have all of our social media pages, Facebook, Instagram, but moneyhourradio.com is a great place to start because you can go there and subscribe to our YouTube channel, Apple or Spotify to hear any of our past shows. And sometimes we'll throw on an extra show. So last week, we threw on an extra segment just for our YouTube listeners. So please go sign up, subscribe, make sure you're out there so you know. We'd love for you to follow us where we'll be releasing more content. So again, moneyhourradio.com to find out more. Anyway, we're out of time and we'll be back next week.